Hi everyone, welcome to the Market Economist. Today we will cover a very important and a fundamental concept of what is a yield curve, what are spot and forward rates, and what is bootstrapping. So here's the agenda. We'll look at what is bond yield, why is it important to look at bond yields, examples of yield to maturity and the yield curve, constructing a zero coupon yield curve using a method called bootstrapping, and finally we'll see what are spot rates and forward rates. So let's begin. What is a bond yield? Yield to maturity is the annualized required rate of return and investor demands for investing in a bond instrument. So it is the required rate of return that the investor demands. If you look at the two tables below, on the left side in the table you'll see that here is an example of a 3-year maturity bond which pays a coupon of C1, C2 and C3. At the end of the first year it pays coupon C1, at the end of the second year it pays coupon C2, and at the end of the third year, that is at maturity, it pays the coupon C3 plus you get the par back which you had invested. So like for any other asset class, the price of the asset, which is the price of the bond here, is nothing but it is equal to the present value of each of these cash flows. So you'll see the present value of the bond is equal to C1 upon 1 plus y plus C2 upon 1 plus y square plus C3 plus par upon 1 plus y to the power 3. So you're discounting each of these. Now the discounting rate that you will get by equating these coupon flows, these cash flows, to the current market price. So the bond would be trading at a certain market price. When you calculate the market price with the discounting of each of these cash flows, you'll get a certain y percentage. That y is nothing but the yield to maturity. So on the right side you'll see PB here, which is the yield of the bond, the price of the bond is equal to sum of all the future cash flows discounted at the yield, which is y. So y is always equal to the required rate of return that the investor will want to invest in a bond. Yield compensates the investor for the perceived risk of investing in a bond irrespective of the coupon it is paying. For example, if coupon that the bond pays is equal to the required rate of return, the bond will trade at par, which means it will trade at a face value of 100. So if you put the coupon and the y as the same, right? So the price of the bond will always be 100, and that is mathematically also true, right? And similarly, if the coupon paid is less than the required rate of return that the investor is demanding for taking on the risk of investing in that particular bond instrument, then the bond will always trade at discount. That is, it will trade at a price lesser than the par value of 100. So that is because the yield required is high. So the investor is saying that the perceived risk that I'm taking is higher than the coupon that the issuer is paying me back. So he will not want to buy the bond at par, he will always want a discount. And through the discount, through the reduction in the price of the bond that he is paying initially, he will enhance his rate of return. That is, the y will adjust upwards because the price that the investor is paying has been revised downwards, has been pushed downwards. Now, why is understanding the yield curve important? Yield curve, especially the sovereign yield curve, gives extremely vital information regarding the economy. First, cost of funds for the government. This influences the fiscal policy, right? So cost of funds for the government is an extremely important indicator, because if the government is able to borrow, so usually the governments across the world run in a fiscal deficit, right? So if the cost of fund for the government is less, that means the government will have headroom for fiscal expansion. If the cost of fund for the government keeps on increasing, that means it's a big problem for the government, because it will spend more of the future borrowings that it will do in servicing the debt or servicing the interest component of the debt, which will reduce its capability to spend on more productive uses. So that's why it is always very important for any government or any economy to keep a check on the cost of funds for the government, that is on the yield, especially the long end of the yield curve. Second, it is a predictor of economic cycle, inflation and growth expectations. While stock market often reacts to surprises, bond markets are usually much more mature and they have risks baked into the yield curve to a good extent for all the future tenors. So looking at the yield curve has a lot of advantages. It gives a very good information. The slope of the yield curve, the steepness of the yield curve gives a very good information regarding what the market is expecting to be for the economy to look like in the next few years. So that's why it's a very important indicator. Third, it is a feedback loop for monetary policy. So the yield curve contains monetary transformation information because it connects the short-term rates, which are driven by policy rates, to the long-term interest rates, which actually drive the economic activity. So like I said earlier, long-term interest rates, keeping long-term interest rates in check is a very important thing for the central banks, because long end of the yield curve drives what rate a business or a corporate will pay for its future borrowings. So for example, if the yield curve, if the long end of the yield curve is very high, very steep, that means borrowing for any corporate or even for a personal loan or a home loan or a loan for any other retail loan, it will have to compete with the yield for the government, right? Because if the government bond is having a very high yield, your corporate will be competing against that yield, right? And if the government yield is very high, the corporate bond will also have to have a very high yield. So this cost of fund will not just increase for the government bonds, but it will increase for other corporate bonds as well, which is not that great. It will reduce the corporate profitability, which will transmit into other economic difficulties within the economy. It will lead to higher cost of funds for the company, which will reduce its profitability, and then that will reduce overall company being able to spend on employees, on R&D, on expansion, on capital expenditure, etc. So it's not a good thing. So it's very important for the government and the central bank especially to keep a check on the cost of fund and especially the long end of the curve. Third, its utility fourth, as the utility of as a discounting curve. So although yield curve is only a discounting curve for the government bonds or the corporate bonds, which we would be taking the yield curve out of, but it also gives a sense of what discounting curve should look like. If we add a equity risk premium to this discounting curve, which is a risk-free discounting curve, if we take example of a government bond, it can be used as a discounting curve. But yeah, then this is only a conceptual or academic concept. In reality, no one really uses discounted free cash flows for arriving at the present value or the price of an equity instrument. So we look at an example of yield to maturity. So this is a 5-year maturity bond which pays a coupon of 6% annually, and the market perceives it to be much more riskier, hence it demands a 10% return from the issuer. So instead of buying this bond at face value of 100, here's how the market will price it at issuance. So the term is 5 years, coupon rate is 6%, yield to maturity, let's say here is 10%, because the investor community is thinking that if I want to invest in this bond, 6% coupon that the company will pay me is not good enough. So how will the market arrive at the present value of this bond? So face value is 100. If you look at the cash flows, after first year we get 6 rupees back. After second year we get 6 rupees again back. so on and so forth. After 5 years we get 106 rupees back. We discount all these cash flows and then we arrive at 6 upon 1 plus 10% to the power 1, which is 5.45 rupees. At the end of year 2 we get 6 upon 1 plus 10% to the power 2, which is 4.96 rupees, and so on and so forth. So we have these discounting for all these future cash flows, and if we add all of these we arrive at the price of the bond, which is 84.84. So this is how by reducing the price of the bond, the market is arriving at a required rate of return that it demanded for investing in this particular bond. So this is an example of yield to maturity, but in reality the yield curve does not have a one yield across all the future cash flows. In reality, yield curve tells a more deeper story. In reality, the required rate of return at each maturity bucket is not the same. Market typically expects higher yields from longer maturity dates, and in future we'll cover that as well, why market expects higher yields from a higher maturity. So in reality, prices would go something like this. So here you see what I've done is the cash flows are exactly the same as that of the previous example, but here the discounting that we'll be using is different. So at the end of the first year the discounting is 10%, at the end of the second year discounting is 10.3%, at the end of third year is 10.5%, and so on and so forth. So now when we arrive at discounted future cash flows, we get 5.45 rupees, 4.93, 4.45, so on and so forth, and the price of the bond is slightly lesser than the price of the bond we arrived at using just 10% as a discounting factor in the previous example. So now the price is 82.61. So for higher yields, the discounting has made the price of the bond go lesser to accommodate the higher discounting. So here is how the yield curve actually looks like. Now we'll look at bootstrapping a yield curve. Bootstrapping the yield curve is a recursive financial method to build a zero coupon yield curve from market prices of coupon paying bonds or swaps, starting with short-term instruments like treasury bills and sequentially deriving rates for longer maturities by solving for unknown rates that price the instruments to their observed market value. What we are doing here is essentially we will start with the shortest maturity instrument to arrive at its spot rate, its yield, and then we'll build on plugging that spot rate into the equation to arrive at the second spot rate. Let's look at an example. Here we take three different bonds, one maturing in 1 year, one maturing in 2 years, the third maturing in 3 years, and we take all these bonds offer different coupon rates. So here an example, we look at bond with 1 year maturity which offers a 0% coupon, a bond with 2 year maturity which offers a 4% coupon, and a bond with 3 year maturity which offers a 4.5% coupon. We know the market prices of all these bonds. Now if we plug the market price and the coupon that it is going to pay, so the yield of 1 year maturity bond, which is S1, which is spot rate, S is spot rate, so S1 can be calculated. You can simply put this as a formula, 96 is equal to 100 upon 1 plus S1. So S1 comes out to be 3.5%. Now and these three different bonds are of the same issuer, so essentially they have the same risk profile, and let's assume that everything else is same, so same collateral, everything, all the other risk profile parameters are same. Now for 2 year maturity bond which offers a coupon of 4%, the price is 98.5. so how we arrive at spot rate is 98.5 is equal to 4 upon 1 plus 3.5% plus 104, which is 4 as a coupon, plus 100 the par that you're going to get back, 104 upon 1 plus S2 square. That way you arrive at S2, which is 4.86 And then for the third bond, again we do the same thing. 99, which is the price, is equal to 4.5, which is the coupon. 4.5 upon 1 plus 3.5% plus 4.5 upon 1 plus 4.86% whole square plus 104.5 upon 1 plus S3 whole cube. That way you arrive at S3, which is 4.87%. So that is how we arrive at all the three spot rates, and if you plot all these spot rates, you will get the yield curve that we saw earlier. Now we understand what are spot rates. Spot rates are essentially zero coupon yield curve. Now this is a spot rate that we understood. What are forward rates? So spot rate is the price or yield for transaction agreed upon today for immediate settlement, whereas a forward rate is rate agreed upon today for a transaction that will occur on a specific future date. This represents the market's expectation of what future interest rate will be for a period starting at a later date. So here we had already seen what spot rates are. Now if you want to see what forward rates are, you just use this equation. Now we will look at spot rate versus forward rates. So spot rate is the price or yield for a transaction agreed upon today for immediate settlement, whereas a forward rate is a rate agreed upon today for a transaction that will occur on a specific future date. This represents the market's expectation of what a future interest rate will be for a period starting at a later date. So spot rates discount directly to today, whereas forward rates decompose the same discounting into sequential 1 year expectations. For convention, and so here we'll look at an example. We'll look at the same example that we took for bootstrapping S1, S2 and S3 spot rates, and we'll see how we can decompose S2 into S1 and F1, 2. S1 is again the spot rate 1 and F1, 2 is the forward interest rate for a loan or investment that begins at time 1, which is 1 year, and ends at time 2 years with a tenor of 1 year. And F2, 3 is the forward interest rate for a loan or investment that begins in 2 years and ends at time 3, which is 3 years, also with a tenor of 1 year. So we'll look at that now. So if you look at the example at the table below, for a 2-year maturity bond, we had seen how we can decompose that. We can arrive at S2 using the price of the bond, and S1 we had already seen how we had already calculated using 1 year maturity bond. So now we know that 98.5 is equal to 4 upon 1 plus S1 plus 104 upon 1 plus S2 square. But 1 plus S2 square, which is the spot rate, the second spot rate, can be decomposed into two rates. 1 plus S2 square means discounting for 2 years. Now discounting for 2 years can be decomposed into discounting of 1 year at S1 and then applying a forward rate on top of that discounting. So on the right side you'll see the same equation decomposed into S1 and forward rate instead of S2. So 4 upon 1 plus S1, which is same as the earlier one, earlier formula for spot rate, and 104 upon 1 plus S1 into 1 plus F1, 2. So that F1, 2, if you calculate it that way, you get the forward rate 1 year out from now with a maturity of with a tenor of 1 year. Similarly, for 3-year maturity bond, we had seen how we can calculate the spot rate S3. Now you do the same thing again here. 4.5 upon 1 plus S1 plus 4.5 upon 1 plus S1 into 1 plus F12, which we already seen both of these rates, plus 104.5 upon 1 plus S1 into 1 plus F1, 2 plus into 1 upon 1 plus F2, 3. So that's how you arrive at F2, 3. So F1, 2 from this equation is 1 plus S2 square upon 1 plus S1 minus 1, that is 6.15%, and F2, 3 is equal to 1 plus S3 cube upon 1 plus S2 square minus 1, which is 4.9%. So friends, today we have seen what is a yield curve, what are spot and forward rates, we have seen a few examples, and finally we saw what is bootstrapping. Thanks for staying with me. If you like such content, subscribe to my channel and see you next time. Thank you.